Your profit and loss statement is one of your most basic financial statements. It's the one that the bank's going to ask you for when you're getting a loan. It's the one your CPA is going to want whenever they do your taxes. But do you know how to read a profit and loss? Do you know what it's even telling you? I'm going to go through that in this video. I'm going to share my screen and walk you through an actual profit and loss statement. We can go line by line and tell you what it means and how to read it and how to know if your business is doing okay. Before I jump into the screen share, just a couple of basics. A profit and loss measures activity over time. So the time period that you select whenever you're running your profit and loss statement is really, really important. Also, a profit and loss, a P&L, an income statement, a statement of revenue and expenses, it's all the same thing. All it's doing is it's showing you your revenue and expenses over a certain time period. So I might use profit and loss and P&L interchangeably in the video. And if you notice, this is not my normal office. This is my office at the bookstore that Jessica and I are making. It's almost done. It's very echoey. Hopefully that didn't come through in the video. And I'm tucked away in the corner to hide between windows so that there's not too much of a glare. But let's jump in so that the next time you have to pull a profit and loss and send it to somebody, you know exactly what it is you're actually sending. This is an actual P&L that I pulled from QuickBooks for an actual author client, but I took the name, changed it to Acme Press, and I took all the numbers and changed them so that it could be more anonymous. Also, some of the titles of the account numbers I changed a little bit just to keep things more anonymous there as well. But this is what an actual P&L would look like. I put it in Excel, I added some columns so I could fit my big head on the side. And I also changed kind of where the columns are to make it make a little bit more sense. But this is virtually what you would see coming out of QuickBooks if you run a P&L. A couple of things to notice. I ran it for January through December of 2025. So like I said, a P&L measures activity over a time period. That time period is really important. I also did it compared to the previous year. And I added a column for the percent of income for every one of these line items. And I'm going to go over why that's important in just a second. But first, let's go through what a profit and loss is telling us. Let's zoom in a little bit so we can see these numbers a little bit better. So with every profit and loss, at the top, you're going to have your revenue. This is money that you've earned. So all that's coming up here. And then right under total income, you're going to have cost of goods sold. Cost of goods sold is the cost of the items that you're selling. So if you're selling physical books, then the cost of the books that you've sold goes into cost of goods sold. Those costs are listed separately from your other expenses. The reason that is because we can come down here now, we get gross profit. Gross profit is essentially the money you get to keep after selling something. Because whenever you sell a book for, say, $10, if it costs you $3 to produce that book, then your gross profit would be $7, and that's what you actually get to keep. Under gross profit, we list out all of our expenses. So this would be considered your overhead, advertising, assistant services, bank charges, continuing ed, publishing expenses, rental expenses, shipping, freight, delivery, vendor events for in-person events. And then all the way at the bottom, we have total for expenses and then net operating income. And then we have net income. The difference between net operating income and net income is just your other income and expenses. That might be things like cashback rewards, miscellaneous expenses like depreciation that may be entries that your CPA has posted, things that don't really have to do with your normal operations. A lot of times though, your net operating income and your net income might be the same, like in this case. So really a P&L is just a list of numbers. It's your revenue and then it's your cost of goods sold. You subtract those two to get to your gross profit. And then from your gross profit, you take all your expenses, you add them together. You subtract your total expenses from your gross profit, and that's your net income. Or if you spent more money than you made, it would be your net loss. But how do you know what's good? Like if we look at this profit and loss specifically, if we look at 2024 and we go all the way to the bottom, whenever you hear people say like they skip to the bottom line, this is what they're talking about. Or when you hear like, what was your bottom line? This is what they mean. Your bottom line is the net income on your profit and loss. 2024's bottom line showed a loss of $4,000. It's obviously not great. We don't want to lose money. But then 2025's net income showed a bottom line of $30,000. That's much better. Is it good though? Is that enough? Should it be more? Should it have been less? How do you know what's good on a profit and loss? And that's really what I want to focus on more in this video. So a profit and loss in and of itself, just a single year or a single time period with nothing to compare it to is actually pretty useless. You have to compare a profit and loss to something to know if it's good. That something that you compare it to might be your own assumptions, your own expectations. But I'm going to go through 3 different things that you could be comparing your numbers to indicate whether or not your numbers are good numbers. So the first thing that you might want to compare your numbers to are other authors, other businesses. You want to know how you're doing compared to the rest of the industry. And how do you get that information? A lot of industries have these industry reports where you can actually pull the averages for other industries and how they're doing. And a lot of times those reports come as percentages of income. So you'll just see lists of numbers and it'll say like for this industry between $0 in revenue and $250,000 in revenue, they spend this much money on advertising, but it'll be listed as a percent. So it might be like 5% on advertising, or it might have percentages for total operating expenses or total overhead. The main problem that you're probably thinking right now is, where do you get an industry report for an indie author? Or what if you're a hybrid author? What if you do direct sales? What if you don't do direct sales? What if you're wide? What if you're not? What if you're on Kindle? How do you get something to compare it to? And the problem is those reports virtually don't exist. That's why it's really important to be in communities and be around other authors where you can compare notes. You don't have to share all your numbers, but you can ask, hey, what's everyone's profit percentage? What's everyone's gross profit percentage? What's everyone's ad spend percentage to revenue? And get those numbers from other people so you can compare yourself to similar authors to you. One of the benefits with working with us is that we work with a lot of authors. And so we can say whenever we're talking to our clients, hey, we've noticed that a lot of other authors are spending this percentage of their income on ads, or this percentage of their income on publishing expenses or processing fees, or whatever the case is. And so we can give some of those insights, even if you're not having to buy these industry reports or if you don't have access to other authors. If you don't have access to other authors, I'm going to put in the description a link to our author community over on School. It's just other authors trying to build their businesses, and it's a place where you can ask questions like this. Okay, so after that, what's something else you can compare your numbers to? Something I really like to do is compare your numbers to other periods. That's why I always like to pull up comparisons. What does 2025 look like compared to 2024? Is it growing? At what rate is it growing? If my revenue is growing, is revenue growing faster or slower than expenses? The thing with looking at time periods and comparing them is that you want to be careful about how you're doing this. If you're looking just at your current or most previous month, let's say we're looking at April 2026. If you compare April 2026 to March 2026, it's not going to give you very much data. I mean, you'll be able to see how things changed from one month to another, but a lot of things can happen within a month to cause these blips. So looking at just month to month really isn't that great of a comparison. I really prefer looking at longer time periods compared to other time periods, at least 12 months. It's really cool if you can pull like a report that shows a rolling 12 months, so that if we're in April or if we're in May and we want to look at the 12 months that ended in April, we can compare that to the 12 months that ended in the previous April. And that kind of evens out all that seasonality. So you don't have to worry about holiday sales, launches, and things like that. You can kind of know that if you're looking at comparable periods, then the data is comparable as well. Then you can start figuring out, is this good? So for this specific profit and loss, we can see that total income more than doubled. We went from 151,000 to 323,000. Our cost of goods sold actually also more than doubled. That's okay. It does show that we have a lower gross profit percentage than we did the year before. So for every dollar that we for every dollar that we made, we kept 79% of it in 2025. But in 2024, we were actually keeping a little bit more. It's not uncommon because there's sometimes this negative economies of scale with authors where as you grow, certain things get more expensive instead of less expensive. Maybe there were special editions in here. Fulfillment expense obviously increased where it didn't exist the year before. So that's a huge change. Merchant fees is a larger percentage of revenue than it was the year before. So those kinds of insights you can start tracking and figuring out, okay, why did this increase so much? Why did my merchant fees go from 2% to 3%? Maybe that's something worth looking into. Did I change processors? And if I did not change processors, like the payment processor, then why did the fees increase so much? And so your profit and loss kind of gives you those red flags to know where you should be looking for more information. Let's keep going. This is something good to point out here. Whenever you're comparing your profit and loss from one period to the next, it's helpful if you have comparable data. So if I look at this and I just say advertising expense, I see that it's 0 here for 2025, but it's $89,000 for 2024. That's because in 2025, we started breaking out the different types of advertising expense. We have the actual ad management, we have the ad spend itself, other marketing expenses, and other marketing services. Whereas in 2024, we just lumped everything into advertising expense. So comparably, you can't tell how much was ad management compared to the previous year, but we can look in total and see how much things changed. So ad spend and management and everything else increased for this client by quite a bit, from 89,000 to 155,000. But notice the percentage of ad spend to revenue decreased 10 percentage points. So from 59% to 48%. That tells me that the advertising is way more effective in 2025 than it was in 2024. Getting a better ROAS, in other words. So this is a good thing. And so if I'm comparing current year to prior year, I'm going to do similar things with all the large items. I might stop at anything over, say, $1,000 or $10,000, depending on the client. Or we might look at things that make up a certain percentage of revenue or more, or things that show a certain percentage or dollar amount difference from the prior year, and just think about what changed from that year. So continuing education doubled. Interest paid went way up. Obviously, there was some debt taken out, and so there were some loan payments on here. Office supplies increased. Published expenses increased. We just do that all the way down till we get to the bottom, and we see what happened. We see that our total expenses went from $129,000 to $227,000, and that tells me that our income increased by more than our expenses because now we're showing an income instead of showing a loss. So what does this tell me about this specific client is whatever they did for 2025 compared to 2024, move them in the right direction. Is it good? Is it good enough? I don't know. You can't really tell just from a profit and loss. It's going to depend based on what their goals were. What if they're expecting to have $100,000 net operating income? Maybe they didn't really hit the mark. What if they have a ton of inventory sitting over on the balance sheet that's not reflected here? So really important to note that your profit and loss is an incomplete picture of your business. This does not show everything. You spend money from your business that does not show up on a profit and loss. For example, if you take distributions out of the business for your personal pay, that does not show up on your profit and loss. Taxes, your income taxes, might be one of your biggest expenses other than advertising expense. That does not show up on a profit and loss unless if you're categorizing it incorrectly. If you're tracking your expenses on your QuickBooks or whatever for tax purposes, you can't deduct the taxes you paid on your income statement, on your P&L. Instead, that goes over on the balance sheet as like a distribution or prepaid taxes, depending on the type of business you have. But at the end of the day, you'll notice there's no tax expense in this business because it's not included in this. So if this author ended up having to pay $10,000 in taxes, that's not reflected here. And they actually got to only keep $20,000. Also not reflected on a P&L, on a profit and loss, is the principal portion of debt payments. Whenever you pay a loan, it reduces a liability. That's not shown on a P&L. That liability is over on your balance sheet. We'll do a whole different video on balance sheet. We might even do another video on just all the financial statements and how they interact with each other. But whenever you pay back a loan, the principal portion of that payment does not show up anywhere on here. The interest portion does. And here's the reason. Whenever you get a loan and you take those proceeds and you use it for something, getting the money from the loan is never counted as income up here. Instead, it just increases a liability over on your balance sheet. So paying back the loan can't be an expense. Now, the expenses that you incurred whenever you use the loan, those expenses would be on your P&L. So let me give you an example. If you took out a $5,000 loan for office supplies and the bank deposited those loan proceeds into your checking account, that deposit of $5,000 should not go as income on your P&L. That's not income to you. Instead, that $5,000 deposit should be considered an increase of a liability on your balance sheet. So on your balance sheet, you'll see an increase in checking and an increase in loan payable. Now, whenever you use that $5,000 to buy your office supplies, you're going to show that as an expense. And so you'll see a decrease in cash or in checking on your balance sheet and an increase in an expense over here on your P&L. So then whenever you pay back that loan, the portion that makes up the principal, that original $5,000, that also doesn't show up on your P&L. That's just a decrease in your checking because you paid the loan back and a decrease in the liability. But every time you make a payment on a loan, some of that payment goes towards the principal balance of the loan and some of it goes to interest expense. That interest expense does get deducted on your P&L, does show up right there. So that's another thing here. So just to recap, 3 things that are not shown on your P&L, but it is cash coming out of your bank account, is your owner's draw if you're taking those as distributions, your principal paid on loans, and your taxes, specifically your income taxes. Sales tax is a whole different monster that I'm not going to even cover in this video because it can get really complicated with how it's treated in QuickBooks depending on how you're doing it. So we're not going to worry about sales tax for this. Sorry. Okay, so we talked about you can compare your numbers to industry averages or other authors. We talked about how you can compare your numbers to prior periods. The third thing that you can compare your numbers to are themselves. I always like to show a column here that shows the percentage of income of every single line. So you can see here, 323,000 is 100% of 323 at 323,000. That's harder to say than you would think. Then every other number in here is showing us the percentage of that to total income. So we can see here, we get some really good information. Almost half of this author's income came from sales of hardcover books, followed by 18% to paperbacks, and then 13% to ebooks and so on. And so you can use this information to kind of build yourself a little mental pie chart and figure out like, where's the most of your sales coming from? Where should you be focusing your efforts? Should you be focusing more on hardcovers and getting more of them out the door? Or do you want to start increasing sales of audiobooks and ebooks and things that maybe are easier and cheaper to distribute because there's no physical costs involved with you producing that after it's already been produced? We already talked about your gross profit. This is a really, really important percentage here is your gross profit percentage. Again, what percentage of your income that you make do you get to keep to go towards all your overhead? So that's shown here. This one is 80%. What's a good gross profit percentage? Man, it really depends. It depends on what type of author you are. If you're doing direct sales and managing your own inventory, or if you're doing just royalties from Amazon or other retailers, that's going to vary wildly. But for a direct selling author, managing their own inventory, lots of physical book sales like this one, I like to see gross profit percentage at least 75%. So for this author, they started at 82% in 2024. They're now at 80% in 2025. Still okay, but I would be wary. I would be careful that number doesn't continue to drop to less than 75%, because then what happens is even though income might be growing, you're keeping less and less of that pie. And now you're relying more on volume in order to cover all your expenses. And then ad spend starts to get really expensive whenever you need to have sale after sale after sale. Okay, so let's keep moving down the list here. Advertising expense for this author was 48%. That indicates a 2 times ROAS, maybe just better than 2 times ROAS. It's not amazing. It's not great. In my experience, at least a 2 times ROAS is needed for about break even. Every author is going to be totally different. But if your ROAS is less than 2%, then whenever you consider all your other expenses, you're probably not making any money. Obviously, that's not always the case. And you can see that here, this author had a 60% ad spend to revenue. That means that their ROAS was less than 2% and they lost money. Now it's more than 2%, a little bit more than 2%, and they made a little bit of money. Moving on down, continuing education, 3%. I wouldn't say that there's like a rule of thumb here. This is really just what is your budget for continuing education? How much of your income do you want to spend on things like conferences and courses? So that's going to be totally up to you. Shipping, freight, and delivery. I may have preferred to see this up in cost of goods sold, especially if we are putting shipping income up here. So we see this 24,000, that gets offset by this 25,000. This is okay, but if I would do this again, I would probably put shipping and freight up here in cost of goods sold, just so that we see the true gross profit after subtracting that out, because we can say that like $25,000 of this gross profit is actually just the shipping expense that we were reimbursed for up here. So we're counting this 24,000 as shipping income. I feel like we probably should have put that shipping expense here in cost of goods sold. And if we keep going down, we get to net operating income and net income. And this would be considered your net profit percentage. How much of your total income before any expenses, before cost of goods sold, do you get to take home and use to pay yourself and to pay your taxes? This author has 9% profit percentage. Is that good? I'd say that's actually a little bit low, because from this number, again, we have to pay the author their owner's pay, and we have to pay their taxes, and we have to pay their debt. I would prefer to see this significantly higher if the author is taking an owner's pay that's not shown on the P&L, something that's like a distribution instead of a salary, because that has to come from here. And we'd like to see that be about 50% of gross profit. Plus got to pay taxes, plus you have to pay your debt payments. If you're a super nerd and you've ever heard the term EBITDA, earnings before interest, depreciation, tax, and amortization, that would be derived from this number with some adjustments. Ignore EBITDA. I don't like that term. I don't like that measure. I don't think it makes any sense, because why wouldn't you subtract interest and the cost of the assets that you've purchased and taxes and all these other things from your net income whenever you're analyzing your business? I don't understand. But in a nutshell, this is your profit and loss, or your P&L, and how you would read it. Wasn't that so much fun? I hope that maybe you have a little bit better understanding on what your profit and loss is and how to read it and how to tell whether or not your numbers are good or bad or otherwise. And do you like content like this? Do you like these deep dive kind of tutorial contents? I like doing them. They give me something to say instead of just having my face on the screen. but I don't know if that's helpful for you. So if you don't think that this kind of content is helpful, let me know. If you do like this, or if there is a certain type of walkthrough that you would like to see, put that in the comments as well. And either way, I will see you next time.